The US debt ceiling is a limit set by Congress on the amount of debt that the federal government can legally owe. It covers both public debt, which includes treasury bonds and other securities held by the public, and intra-governmental holdings such as government trust funds. It's worth noting that this ceiling does not restrict Congress' ability to pass future budgets, but instead limits the Treasury's ability to borrow funds to pay for government operations already approved by Congress. Now, let's talk about what happens if the US debt ceiling is not raised and the country defaults. The immediate impact would be on the government's cash flows. If the US Treasury couldn't borrow more money, it would have to rely on incoming revenues to pay its obligations. Because the government consistently spends more than it takes in, it would have to either cut spending or default on some of its obligations, which could include everything from salaries and benefits to payments to contractors and interest on debt. A default by the US government on its debt obligations could have severe and long-lasting effects. Market turmoil. The financial markets would likely react negatively to a US default, leading to sharp declines in stock prices, dollar sell-off, credit spread widens, and potentially causing a financial crisis. Credit downgrade. Credit rating agencies would likely downgrade the US credit rating, which would increase the cost of borrowing in the future. Global economic impact. Given the central role of the US Treasury securities in the global financial system, a default could lead to a global economic downturn. Many financial institutions hold US Treasury securities, so a default could lead to a reduction in their capital and potentially into insolvencies. Increase in borrowing costs. Interest rates would likely rise to reflect the increased risk of lending to the US, which would increase the cost of borrowing for businesses and households as well as for the government itself. Possible recession. The combination of market turmoil, reduced government spending, and higher borrowing costs could push the US economy into a recession. In summary, not raising the debt ceiling before the X date and the subsequent default by the US could have severe economic consequences both domestically and globally. That's why discussions around the debt ceiling often lead to a heightened tension and uncertainty in the financial markets.